Thanks for coming back to another episode of Pitch It, a fintech conversation amongst founders, investors, and friends. I'm your host, Todd Anderson, Chief Content Officer at FinTech Nexus. And what we do is we take a peek behind the curtain. What motivates someone to start a company? How do investors make the right bet? What do accelerators do during and help enabling the process of growing your company? How do banks think of founders? Not to mention, we try to have some fun, and what you'll see is we'll also do some special episodes. We have some new features coming. So stick with us, and you'll get all you'll need to know about the fintech startup landscape. Pitch It is really a part of a larger podcast network here at FinTech Nexus. You can go to my colleague Peter, our co-founder and chairman, for FinTech One-on-One. You can subscribe to his feed, or we have our newest podcast by one of our writers, Isabel Castro, the FinTech Coffee Break. For everything produced by FinTech Nexus, you can check out FinTech Nexus Podcast, which is really our content fire hose. All shows, webinar replays, even in-person event content, not to mention our weekly news show. As always, we hope that you rate the show and write a review. I try to really take listener feedback seriously, and as it helps make the show better. You can also follow the podcast and all of our podcasts on the feed of your choice, whether it be Apple, Spotify, wherever you like to listen, or come directly to news.fintechnexus.com. Now, let's get on with the show. On today's episode, I'm joined by Joe Cianciolo, founder and CEO of HomePace. HomePace's mission is to enable homeowners and home buyers to gain greater financial flexibility. And they do this by allowing the homeowner to unlock the equity built up in their homes. Part of the most interesting aspect to their innovation is that it gives homeowners this financial flexibility without taking on more debt, which is something all homeowners struggle with. At the same time, it gives institutional investors access to the real estate asset class. Joe and I talked about where the idea of HomePace originated from, some of his time at both SecondMarket and FutureAdvisors, which were both very much early stage and early on adopters in the fintech community, the typical use of funds through this type of transaction, how the overall real estate market impacts their business, playing football at Penn State, raising capital, and much, much more. Before we get to the episode, just wanted to let you know if you want to sponsor an episode, come on as a guest, or sponsor one of our many digital or in-person offerings, feel free to reach out to me anytime. That's just Todd, Todd, at fintechnexus.com. Without further ado, Joe Cianciolo, founder and CEO of HomePace. I hope you enjoy the show. Hey, Joe, welcome to the podcast. How are you?
I'm doing well, Todd. Thanks for having me.
Of course. So I'd like to kick off. Just tell the audience and tell me a little bit about yourself, kind of what's your background been before, obviously, your current venture, which is HomePace. Kind of tell us a little bit about yourself.
Yeah, I've spent the vast majority of my career in and around fintech. Everything from the very early days in the illiquid marketplace side of the world with SecondMarket, and then later on, and kind of in the robo-advisory space, was very early on the team at FutureAdvisor, which we ultimately sold to BlackRock back in 2015. And then, obviously later on, kind of, matriculated my way to starting HomePace here at this point.
Now, I always like to ask, in terms of being a founder yourself, did you always think you'd eventually get to that point? Or did you find something with, the space that you're in now? And obviously we'll get into more about what you guys are doing. But did you find an issue and said, hey, no one's solving this, I should solve it? Or were you were on that path already?
It would actually, I would call it a little bit of both.
Okay.
Being a founder and, building something from the ground up was something I kind of always wanted to do. At the same time, never really had the thing that hit me where I was like, hey, this is the problem that I need to go solve, and I'm the guy to go solve it. And even more than that, I know the people that I need to pull in around me to go solve this particular problem. Until we kind of came across HomePace here. Had gradually made my way down the size of company stack throughout my career. You know, when I was at Second Market, we were 50 to 100 people. When I joined FutureAdvisor, I was employee 4 there. And then ultimately now HomePace, obviously I was employee 1 or 2, depending on whether you talk to me or my co-founder first.
So what brought you to the idea of HomePace? And while answering that, kind of how'd you guys come up with the name?
Yeah, so I wish I had this very clever story for you on the name of the company. You know, but there's no fantastic backstory. Like, it hit me one night at an epiphany. Naming a company is much harder than people realize.
Oh yeah.
I think there's a lot more downside than upside in what you name your company. You're not going to become an overnight success because you came up with the best name, but you can probably sink yourself with something really terrible
Yeah.
that nobody wants to engage with. My co-founder Joe Cianciolo and I spent several weeks bandying this about and never really came up with anything. And simultaneously, you're looking for something that you can actually go acquire the domain name for at the same time as well. So
Yep.
ultimately landed on HomePace. It was very much down the fairway of what we're doing. You know, obviously helping people extract equity from their home without taking on additional debt and being able to kind of own their home at their pace. So, you know, we kind of backed into it in that way. But I can't say that there was something really, really clever in how we ended up naming the company here.
So tell us a little bit more exactly what you guys do, how many states you're in, and ultimately kind of who's the ideal target, or is there an ideal target for what you guys are doing?
Absolutely. So at a high level, we're a platform that empowers homeowners to extract equity from their home without taking on additional debt and the monthly payments and interest that comes with that on the debt side of the world historically. So we're a new way to extract equity from your home as a homeowner. On the flip side, we also are giving institutional investors in particular an efficient avenue to be able to get exposure to owner-occupied residential real estate without many of the headaches that come with actually purchasing a home outright and having to manage that home on a go-forward basis. So that's what we're doing from kind of the two sides of the business here. As far as kind of the size of the team and where we are at this point, 13 folks across the team. We are remote across the country. I'm in Raleigh, North Carolina. My 2 co-founders, Joe Cianciolo, is in the Salt Lake City, Park City, Utah area. And Megan Graff, who runs all of our operations, is up in Seattle, Washington. We have folks in Boston and Chicago and California and everywhere else. We started the company in 2020, and toward the end of 2020, in the throes of COVID. So remote worked really well then. It's continued to work well for us. We've been able to bring in the best people, I think, to do exactly what those folks need to do. Because we haven't been geographically constrained to date.
Now, when thinking through what you guys do, is it, is the typical homeowner looking to extract equity for a specific reason, whether or not they want to pay down debt or they want a bigger down payment, and they're looking to buy a home? I mean, what does the typical homeowner look like? And are there any restrictions or rules based upon, kind of how they use those funds that are ultimately given to them?
No, very good question. The typical homeowner that we're working with is sorry, I'll go back and start that one over if you don't mind.
No problem. You could just start with the typical homeowner and we'll cut out the first part.
Okay, sounds good. The typical homeowner we're working with, for better or worse, the use case is often consolidation of credit or eliminating debt that they might have built up over time. It's probably, I'd call it 60, 70% of the use cases we're seeing today from existing homeowners. And that's continued to trend up, quite frankly, as you've seen savings rates decline, credit card balances and other types of debts, especially over the last year, have certainly ticked up as you've seen, stimulus checks and things like that start to kind of be pulled back by the government. And so you've had this inversion of what we were seeing during COVID. So elimination of debt is really the most common use case we're seeing. Other use cases include everything from people who are in retirement and want to give themselves an additional cushion. They've sat there and said, okay, I bought my house for $300,000 20 years ago. It's now worth $1 million. I've got a minimal amount of savings saved up, and now, how am I going to buffer myself through retirement? That's really the one that kind of brought me to the space from a founding standpoint here.
Okay.
As I had mentioned, had been really early at FutureAdvisor, one of the very early robo-advisors in the wealth management space. And after we sold that company to BlackRock, I spent another several years at BlackRock leading a lot of the digital wealth technology platforms there and integrating those with large wealth management firms. And one thing we kept seeing over and over was this complete lack of retirement savings that a large portion of the country has. Depending on which stats you look at, usually the numbers rhyme somewhere with 60, 70, 80, $100,000 of retirement savings from a liquid standpoint that many people have. And how do you bridge that gap? And in talking with most of the financial advisors I spoke to, in most cases, those people had owned a home, right? Because they bought that home 20 years ago, and nobody wanted to step into, well, how do you extract the value from that home? Because no financial advisor wants to tell you, hey, you should go take out a reverse mortgage, or you should go take out some more debt. Like, that's just not a conversation that most of them are equipped to have. So turning that on its head, how do you put that equity to work for you, especially if you're in retirement and you don't want to take on another monthly payment in the form of a HELOC or home equity loan, right? You're cash flow constrained. So being able to tap into that via this home equity investment.
And you want to stay in your home ultimately.
And even more than just staying in your home, you want to be able to control the timing of the asset that you hold, which is a real key here. Because we're coming in as equity, because we're partnering with the homeowner effectively, the homeowner has kind of control of when they decide to sell the home, when they want to buy us out of the contract, et cetera. So, really kind of keeping the homeowner in control and, putting ourselves in a position where we can kind of draft off their success.
Now, as a homeowner, I mean, I own a home. I, did a refinance during COVID. And so I'm only a few years into that loan. And obviously I probably haven't built up that much equity. Is there a minimum amount I would have to have built up to, go to your platform and ultimately do a transaction with you guys? Kind of how does that angle or that side of it work?
Yeah, historically, it's about 20% equity or so that we want to see a homeowner have in their home. So, somebody who just came in and did an FHA or a VA loan and put 3% down 6 months ago probably isn't going to qualify, admittedly. But, with the run up in home prices and, the values that have kind of followed along with that, if you bought a home within the last 3 years in almost any market in the country and you put 10 to 20% down when you purchase the home, there's a decent chance you'll qualify on the front end with us. Obviously, we're in, I believe it's 13 states at this point, so there's a geographic component to it as well. But short of that, it's really kind of that minimum 20% equity. More is certainly better because, from an investor standpoint, they're looking at it as a cushion to how likely is somebody going to default on a home. The more equity you have in your home, the less likely you are to hand in the keys to the bank at any point in time.
Now, obviously real estate and the mortgage market has seen quite the, fluctuation from the refinance boom during COVID and kind of led into 2021 to kind of the market we're at today. Does your business correlate or get impacted by what's going on in the overall market? Kind of what have you seen with some of the macro stuff going on in the real estate market and your business overall?
We are certainly correlated long-term to home prices. I mean, when you're working with investors who are looking for exposure to residential real estate, there's no way not to be correlated to home prices and, the expectation that they will over the long term appreciate. On the short term, it's a little less of an impact, quite frankly. Although the bigger thing that we're seeing from an impact standpoint right now is you mentioned yourself, you either purchased a home or most people have done either a purchase or a refinance if they own a home in the last 2 to 3 years when rates were at 2.5%, 3%, 3.5%. Now you're looking at rates that rhyme with 5, 6, 7% for anybody going and getting a refinance or a first lien mortgage at this point. If you already own your home and you're locked in at that 2.5 or 3% rate, the likelihood that you're going to go out and refinance your entire home to take that equity out at this point in time now is very, very low. So we're seeing a lot of demand from those folks who are in their home. They want to take some of that equity out. They don't want to reset their mortgage rate at 6% all of a sudden because they like their 3% rate very nicely. Thank you. And so they're kind of taking this as a way to be able to step in and achieve that, whatever that financial goal they happen to have is, by extracting the capital from their home via HomePace home equity investment.
I'm curious, obviously doing research on this and generally knowing about fintech, it's the education gap for me is probably a bit less than the normal the normal homeowner. So how is that education gap with a typical homeowner, and how much do they understand of this market? Do they immediately think, does this or is this similar to a HELOC, or is this more debt? Like, kind of what's their mindset, and how do you guys bridge some of that educational gap that might exist?
It's a very good question. The people have been trained on you purchase a home via debt, right? And this paradigm that debt is the way you go about it. So getting people to shift that mindset from debt versus our product, which is an equity-based product, is probably one of the biggest educational hurdles, just because it's been so heavily drilled into people that debt, mortgage, home equity, loan, like the words loan, mortgage, and debt have just kind of been so tied to home ownership. That shifting that paradigm is one of the biggest educational tasks we have. When you kind of walk through it, one thing I found from my time in the wealth management space, so when we were at FutureAdvisor and then BlackRock, is most clients, and in this case homeowners, they are trying to achieve some type of outcome, and they're working everything backwards from there. And you have to be extremely transparent with them, but they want to know, okay, what happens in this range of scenarios? They care less about talking to you about, the underlying instrument's an option contract versus a debt instrument. Like, most people don't understand their mortgage, unfortunately, and how debt works. So trying to take the average person through option math is not something that we typically do. We will if people want to go down that path. But what we really spend a lot of time on is educating people on, okay, here's the amount of cash you're going to get up front. In exchange, there's no monthly payments. There's no effective interest rate on this thing. But at the end of the contract, we're sharing in a portion of your home's value when you decide to exit. Here is the range of outcomes you can possibly see on this thing. And we built tools. We literally put in front of them a sheet that says, okay, if your home's up 30%, here's what the outcome's going to be. If your home's down 30%, here's what the outcome's going to be. What do you think your home's worth today? What do you think it may exit at? And they can play with all those scenarios. And I mean, this is all documentation we actually force them to go through before we'll actually execute a contract with them, because we think that transparency piece and making sure people aren't surprised is a real key. And then once somebody has actually entered into an agreement with us here at HomePace, and we've provided them with the cash, and we're now sharing in that the equity of that home going forward, on a quarterly basis, we're providing them with a statement of, hey, here's what, based on the AVMs we're using, the current mark on your home happens to be. If you called us today and wanted to exit your contract, here is what that would look like. And the value in that in our mind is, if somebody's seeing that every 90 days, they know where their home's trending. they can make a financial plan behind it. Because the worst thing you can do to somebody is they enter this contract, they go about their lives like everybody does. They're not paying attention to it. And then 6 years from now, they go to sell their home or they go to do some other financial transaction and they forgot about this HomePace contract.
Yep.
There. And now they're staring down the barrel of something that that creates a financial issue only because they've forgotten about it. If you lead them along the way, you can actually be a help to them as they're making those financial decisions. And we find that with people. They will call us up and say, hey, here's what I'm trying to solve for now. Is there something you guys can do? How should I think about this? And we can actually, give them some alternatives to in most cases, solution for whatever they're trying to achieve.
Has there been any reticence or fear amongst the homeowner, like, someone else now, owns a piece of my home and, are they eventually gonna, take it out from under me? Like, have you seen any of that? Even though I'm sure in your documentation and through these walkthroughs, you tell them and show them we can only have this amount of equity and ultimately you're the decision maker. But, I'm sure there's some fear in something that they're not as familiar with.
Certainly, it's a question that gets asked, no doubt about it. And the easy answer on that, and it's easy because it's true. It's fully at the homeowner's discretion, right? Our contract currently is 15 years. It'll likely be getting extended to 30 years here. So for up to 15 years for all of our existing consumers, they decide when they want to exit the contract. They can sell it tomorrow. They can sell it in 15 years. They can buy us out tomorrow at the third party appraised value, or they can decide to sit on it. It's really at their discretion. And we're not going to dictate to them whether they can paint the outside pink and the inside blue or vice versa or anything like that. Really, all we require is that a homeowner continues to maintain their home, so make sure you don't have a 6-foot hole in your roof and that water pipes aren't leaking and your walls aren't covered with mold, and ideally you don't have 3 rundown cars in your front yard. But short of that, if you want to go put a pool in your backyard, more power to you. If you want to put a
renovation, because ultimately this goes to the appreciation part. When they sell their home, they're sharing in bigger profits and you're sharing in bigger profits.
That's exactly right. So yeah, whatever they want to do to the home, it's really where that, to your point, that sharing in the upside of the home is really valuable, and why we focused exclusively to date on owner occupied, right? If people know they're sharing in that appreciation,
yeah,
more often than not, they're going to do the rational thing, knock on wood, or they're going to do, at least what they think is right, whether we agree with that or not. You don't get a whole lot of bad actors saying, well, you know what I'm going to do? I'm going to go, rip out my wall and leave it exposed to the elements for the next 6 months because that's going to be a really good idea. Like, nobody does that because they're going to have they suffer the same economic consequence we do.
Yeah, I'd like to kind of shift our conversation a little bit. What's the biggest lesson that you've learned since you guys launched, or one of the biggest lessons?
Yeah, I would say it's a lesson I've learned repeatedly and continue to learn, no matter how many times it hits me. But everything takes longer than you expect. You have all the grand plans, and for better or worse, one thing I learned during my time at the Air Force Academy in college is the enemy gets a vote. There's usually something else out there in the environment or the ecosystem that throws up a roadblock, and you have to work your way around it, under it, or through it. There's very few founders I've spoken to who, I can't think of any, who said, hey, you know what? I went and started this company and everything we planned went exactly according to plan. And there were no roadblocks and we had no issues. And I didn't hire the wrong person and have to fire them. And, capital was plentiful and VCs were knocking on my door and it just got really annoying and I didn't want to take their money. Like, that's not the story you hear from most founders. It's usually, hey, we had a really good plan. And then all of a sudden the Fed doubled interest rates in the course of 6 months. Have a
Yeah.
nice day. So, everything takes longer than you expected. Partners never move as quickly as you want them to, et cetera, et cetera.
Do you have a regret that you can share?
With HomePace specifically, I don't, there's nothing extreme. I mean, early on, we looked very much at doing both the homeowner and the home buyer product, meaning equity extraction for homeowners and down payment assistance for home buyers simultaneously when we were just coming out of the gates. We've ended up focusing to date very heavily on the homeowner side of things. It's admittedly the low-hanging fruit in the current capital markets. It's the more effective one to be able to kind of put to work, and it's the larger market, quite frankly. We probably spent a little bit too much time right out of the gates focusing on the home buyer side of things because it was the novel and the sexy thing to do, as opposed to the, hey, the meat and potatoes, let's go do this really well and then we'll expand. We still have the plans to do the home buyer side of things. Lennar is our biggest institutional VC backer. And so you can imagine there's plenty of inroads for us to take there when we do move into the home buyer space. And it's something strategically they want to work on with us. But really kind of having that focus right out of the gate is the one thing. If I went back and said, okay, what are we going to do right now? It probably would have been dial in just a little bit more on that. Outside of that, I wish we would have done it sooner. I've got a 6-year-old and a 3-year-old, and it's a hell of a lot harder running a startup when you've got a 6-year-old and a 3-year-old than it is when you're 25 and you've got no other responsibilities to the world and everything else. But
I have a 4-year-old and a 4-month-old.
Yeah, there you go. So you're a 2-year cycle behind me, basically.
That's
but
right.
You understand it fully. That if I put anything on the regret category, it'd be that. But at the same time, there was, as I mentioned before, there was never that thing that just struck me as, I need to go create this in the world. This doesn't exist, or if it exists, it doesn't exist in the form that I think it needs to exist in. So
how far, or I guess not how far away, but when do you think that you'll be available in all 50 states?
We will probably not for some time be available in at least 1 or 2 states. The one that comes to mind immediately is Texas. Without going too far down the rabbit hole, there's homestead laws in Texas that make a lot of second liens undefensible unless you meet very specific criteria. Even traditional debt products in a lot of cases don't meet that criteria. So we'd be exposing ourselves in Texas to kind of bad actors, basically, who wanted to walk away from our contract, that we'd have to go chase them down, and whether we'd win and have our lien upheld or not would probably be in question there. Outside of Texas, I think it's really based on investor demand, quite frankly. If there's investors that want to put money to work in North Dakota, we'll go to North Dakota. We're not currently there. Part of our strategy out of the gate was making sure we're in places where there is solid expected home price appreciation, ideally a little bit less volatility, and actually population centers, right? It's hard to go acquire many consumers in North Dakota because, nothing against North Dakota, but there's not as many people in North Dakota as there are in Colorado or Washington.
Yeah.
So. Best
piece of advice since launching HomePace?
I think it's probably that some combination of, nothing's ever as good as you think it is, and nothing's ever as bad as you think it is. Everything kind of reverts to the mean. When things are going really well, there's usually something underlying that you're missing, and when things are going really bad, there's usually something on the horizon, if you're doing the right things, that is going to come good soon. So it's, really kind of keeping your head down, and, kind of keeping your feet moving on making progress and focusing on executing as opposed to, chasing the next shiny object.
I see that you guys have raised some equity capital from investors. How did the investment process go? How was appetite for this type of product, and ultimately what you learn about your company, or just what you learn in general through that pitching and investment process?
Yeah, we've gone through 2 rounds of investment so far. Our initial round was led by Bling Capital and Next View Ventures on the smaller side of things. Obviously, right when we were launching the company, myself, Jaboy, or my co-founder, who's our chief investment officer, and then Megan Graff, who's our head of operations. Um, that round, the benefit we certainly had was it was 2020. Capital was definitely flowing from venture capitalists very easily. And, the success that Megan and I had in particular, she was early with me at FutureAdvisor. So we've been part of building a company from its very early days to a very successful exit. So, we had a little bit of that halo effect admittedly behind us. So, being able to get, you know, investors on the phone was not overly challenging. And then when we raised our subsequent round, after obviously building the first stages of the company and growing our product market fit, certainly as you move up the letter stack of venture capital raises, it becomes more challenging. But there was a lot of interest in what we're doing. It's obviously an absolutely massive market. There's not a lot of markets that are measured in trillions of dollars, like the amount of
Yep.
home equity that's out there, no matter what metric you want to use to measure it. So you get the natural interest as a result of that. Home ownership and residential real estate is a space that there's always some level of interest in. Certainly right now, prop tech is taking a little bit of a beating. If you look anywhere from the public markets on down. So it's not quite as shiny as it was a year or 2 years ago, but it's still a space that there's definitely a lot of folks that are interested in it. And obviously, Lennar and their venture capital arm, Linux, who led our round, have a very deep interest in the space. And that was kind of one of the other big pieces of advice that I'd probably give people is, you hear it all the time, but pay very close attention to who you take money from, because it's effectively a marriage for the length of the company's life, right? And we've been very, very lucky on that front. I mean, from the get-go, Bling and NextView and our partners there have been fantastic. And since we did the round with Lennar late last year, as in late December of 2021, so a little over a year ago, they've been absolutely amazing partners in helping us, from a data standpoint, from a thought process standpoint, from understanding various parts of the market where, Lennar has a history of building, 65,000 homes in multiple markets across the country. The amount of data and just insight you can get from those people is something not really to be sneezed at, and has certainly been helpful on our end.
So we have just a few minutes left. I'd like to end a little bit lighter.
Sure.
Do you have a favorite book or the last book that you read?
As I mentioned, I have a 6-year-old. So the last book I read actually was Charlie and the Chocolate Factory. We just finished 2 nights ago by Roald Dahl. Definitely not a bad one to read, even as an adult. Still holds up. As far as favorite goes, recently reread it, Moneyball, the Michael Lewis book. Still find that one fascinating. I've been very big into sports most of my life, and played college football, and kind of been in and around that for basically since I was old enough to walk. So being able to kind of take that financial side of things and pair that up with the sports side of things, I found that very interesting. And like I said, thought it was interesting enough to go back and read it a second time.
Founders always, work hard, obviously, but need to stay sharp and need to stay fresh. Is there anything, obviously you mentioned you have kids, anything else you do to unwind and kind of make sure that you shut off and then come back fresh and focused?
Chasing them around, whether it be at a soccer game or, my son's swim meets, or shooting the baskets with him in the driveway, or playing tag with my daughter out in the yard. certainly pulls your attention away when you're doing those things. It's kind of hard to be half in.
Yeah.
So it's nice as a distraction for a period of time, and they're very good at drawing my attention.
Hmm.
Outside of that, uh, when given the opportunity, anytime I can put skis on, I'm a big fan, whether that's water skis down here in North Carolina or snow skis. It's nice having a partner and a co-founder out in the Park City, Utah area. So, it's a good excuse to be able to get out there and put skis on as well. So in the summer, water skis, and the winter, snow skis.
You mentioned sports. What are some of your favorite sports? Sounds like football and some of the teams that you root for.
As far as sports goes, if it's, I'd pretty much rather watch just about any athletic event on TV as opposed to anything not athletic, if I'm being really honest with you. I grew up playing football, basketball, baseball, soccer, swimming. If there was whatever the season happened to be, that's the sport I was playing. Both my brother and sister and I. I played football in college at Penn State, so still have the obvious allegiance there, as kind of evidenced over my shoulder here, actually. But pro wise, I would have said for a while, whichever team happened to have one of the guys I played with on it. Unfortunately, I think there's really only one guy that I played with in college who's still in the league, Robbie Gould, the kicker for the San Francisco 49ers.
Yep.
I actually long snapped too, funny enough. I long snapped in college. So I know I haven't talked to him in years, but I guess the 49ers as much as anybody because of that, but no deep abiding connection to any other team.
Do you have a favorite vacation spot?
I think I would just go back to anywhere where I can be water skiing or snow skiing. I'm not overly picky. I'm very happy to just get out on the boat here in North Carolina on the lake and go water skiing, quite frankly. And alternatively, it, I am partial, I guess, to Lake Tahoe. We spent a number of years, my wife and I, out in the San Francisco Bay Area, and probably my favorite thing about San Francisco Bay was that you were 3.5 to 4 hours from Tahoe. Not much prettier place on earth than that I've found yet. So I'd probably put that very high up on the list.
Well, Joe, I appreciate you giving me some time and coming on the show. If someone wanted to either reach out to you or wanted to find out more about HomePace, how can they do that? How can they reach out?
Absolutely. Email's always good. Joseph@homepace.com. And then the website for HomePace, www.homepace.com. And then LinkedIn always works as well.
All right. Well, thanks so much, Joe. Appreciate you coming on the show. Continued success to you and the team, and maybe we'll get you back sometime in the future.
Greatly appreciate it, Todd. Thanks for the time today.
Yep. Thank you.